One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason and I am your host. This is the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. And I promise we're going to get to that non-technical part here. It might take another couple hundred episodes or another 100 or so episodes before we get to that, because there are some important behavioral topics that I plan on covering. But you know what? If you don't have the technicals right, you're not going very far, right? So that's why we're focusing on that first and foremost. And within that technical domain, we've discussed accounting, we've discussed enterprise and equity value, we've discussed valuation. Now we're discussing discounted cash flows. And we've been going through these questions. And this is a fun one, I think, for you today. The question I have for you today is this: which cost of equity should be higher? The cost of equity of a $5 billion corporation or a $500 million corporation? And when I say $5 billion or $500 million, I'm talking about the market capitalization of the company. So which cost of equity should be higher? $5 billion market cap or $500 million market cap? So the $5 billion market cap is bigger than the $500 million market cap. So as usual, in order to answer this question, we have to go back to our basic definitions, right? It's always great to remember, what do these terms actually mean? Especially as we're learning them, because if we thoroughly understand the meaning of the basics, we can put them together to answer questions like this, right? So let's go back to this definition of cost of equity. What is it? Well, it's this concept that captures the hurdle rate or the required return that equity investors demand from the company before buying its stock. And it accounts for the risk-free rate, beta, and the equity risk premium, if you remember the exact equation there. So cost of equity is this hurdle that a company has to hit. And let's break this down a little bit. So remember, cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. Risk-free rate plus beta multiplied by equity risk premium. That's cost of equity. So if we kind of break this down even further into the definitions of these terms, how would these terms change based on whether a company is $5 million in size or $500 million in size? So first of all, the risk-free rate. Well, the risk-free rate, it wouldn't change between either a $5 billion company or a $500 million company. That has no impact on the risk-free rate. It's just what government bonds are yielding. That's it. So what about the other components at play here? Well, let's look at beta. Beta represents volatility. And the equity risk premium, if we look at that, represents the premium that investors will pay for equity in a company relative to the risk-free alternative. Okay, so we got a couple of concepts here, this concept of beta and this concept of equity risk premium. So with these concepts in mind, let's now address the question. So a $5 billion company, it certainly has room to grow, but maybe not as much room to grow as a $500 million company that theoretically could generate higher returns, right? It's kind of this concept called the law of large numbers. If you're already really, really big in size, it's hard to grow at the same percentage rate as a company that's much, much smaller. So for example, if you run a lemonade stand and you are able to make $100,000 in profit in a year, it's way it's probably way easier structurally for you to double your income to 200,000 the next year than if you run a lemonade corporation that's already raking in $100 million. It's going to be really hard for you to double that to 200 million, depending on the situation. So it's this basic principle of size, this relative principle of size and how fast you can grow. So there's that. And then also think about the smaller company in terms of volatility. The more small a company is, the more likely it is to be more volatile in the market. And you see this all the time in the stock market. Go ahead and look up McDonald's stock, ticker symbol MCD. Like you'll see that stock really does not change that much on a day-to-day basis. And then go ahead and look up a much smaller stock. I'm trying to think of an example right now. I'm thinking of just like any penny stock, any stock that's trading below, say, $10 per share, and just look at its price history relative to something like a McDonald's or an Apple or an AT&T. Like those are mega corporations, and they're just not quite as volatile as some of the smaller companies, like a micro cap or a small cap company. So volatility is a factor here when it comes to size. So given these differences regarding both growth potential and volatility, which here we can assume that volatility is a proxy for risk, what would you expect to have the higher cost of equity? You would expect the $500 million company to have a higher cost of equity, right? The $500 million company, because it's smaller, it's probably more volatile, which means its beta is going to be higher, right? And if you have a higher beta, you're going to have a higher cost of equity. And then in addition, you're probably going to have a higher opportunity for growth, which means that there's probably more risk because it's not nearly as stable of a situation as a larger company that's already bringing in lots of cash flows. So because of that higher risk, your equity risk premium is expected to be higher. Investors are probably going to be more willing to pay more for the stock of a established larger corporation that has more stable history of cash flows than a younger fledgling enterprise. Does that make sense? So you have both your beta affected here and your equity risk premium affected here, which therefore impacts cost of equity. And so your $500 million company is probably going to have a higher cost of equity. And this kind of makes sense, right? If you're running a company, say you're the chairman of the board, and you say to your CFO, hey, go raise some money and sell some stock to equity investors. Well, the CFO is going to talk to the investment banker, which, hey, maybe you, to try to raise some capital. And they're going to try to price out that capital. They might be able to get a really good rate on the shares and be able to sell new stock for more money if investors perceive your company as lower risk, right? Or lower volatility. So your cost of equity is going to go down, and that's good for the shareholders in the company because they don't need to be diluted as deeply. But contrast that, let's say you're running a company and you're really in dire financial straits, you're barely staying afloat. You go to your CFO and say, please raise me some money, go to the bankers and raise some equity. So then they go to the banker and then they say, hey, we need to raise some stock. And then the banker says, okay, well, I can raise some stock for you, but it's really going to cost you. You're going to have to issue a lot of shares and you're not going to get as high of a price per share as you want. Well, that means that the cost of equity in that situation is much, much higher because equity investors are perceiving a higher level of risk in the struggling company. Make sense? Okay, so that's what I got for you today here on Investment Banking Insights. I am really grateful for you listening to me today and just joining me on the show. I know that at least a few of you have listened to literally every single episode. Thanks for reaching out and telling me. It just makes my day when I hear from you guys. So thank you for that. Hope you're learning as much as I am, and I'll see you here on the next one. Take care.